Everyone loves the idea of the dividend snowball until they actually do the math. You see the charts on social media showing passive income growing exponentially, and you think, great, I will throw $5,000 into a brokerage account and start covering my rent. Then the first quarter rolls around, you check your balance, and you have earned enough to buy a single cup of lukewarm coffee. That is the moment most people quit. They realize that getting paid $1,000 a month for doing absolutely nothing requires a capital base that is terrifyingly large. But here is the good news. The math is stubborn, but it is solvable. Today I am going to walk you through exactly how much money you need to generate a real, livable dividend paycheck, why chasing the highest yields usually results in losing all your money, and how to build that six-figure engine without needing a six-figure salary to start. Before we start running the numbers, I want to be clear about something. I am not a financial advisor, just a guy who is obsessed with the mechanics of wealth. I read the boring reports, so you do not have to. If you appreciate honest math over hype, do me a favor and subscribe. It is the best return on investment you will get for $0. Now, the dream here is specifically $1,000 a month. That is the magic number. It covers groceries, or a car payment, or a decent chunk of rent. It changes your life. But in the dividend world, nobody quotes monthly income, they quote annual yields. So step one is translating your dream into the language of the market. $1,000 a month is $12,000 a year. That is our target. $12,000 in pure, cold hard cash, deposited into your account every single year. Let's start with the common belief. When I first started looking into this, I assumed I would need $1 million to make meaningful income. That is just the number that floats around in our heads. We think you have to be rich to get richer. And while that is partially true, the specific amount of capital you need acts like a lever. It moves up and down drastically based on one single variable, which is the dividend yield. The problem is that most new investors do not understand how that lever works. They assume all stocks pay dividends, or that all dividends are created equal. They look at a tech stock soaring 20% a year and assume it is also paying them income. Usually, it is not. The market is split into growers and payers. If you want income, you have to buy payers. And the price of admission for that $12,000 annual paycheck is dictated entirely by the yield percentage of the assets you choose to buy. Here is the formula. It is the only one you need today. You take your target annual income, which is $12,000, and you divide it by the dividend yield. That is it. Income divided by yield equals required capital. If you go to a site like Yahoo Finance or use any dividend calculator, this is exactly what they are doing in the background. So, let's run the scenario for a standard, somewhat conservative dividend portfolio. A realistic, safe yield for a diversified basket of quality stocks is usually around 3 to 4%. Let's be optimistic and say 4%. You take $12,000, divide it by 0.04, and the number staring back at you is $300,000. That is the reality check. To get $1,000 a month at a 4% yield, you need 300 grand invested. If you want to be safer and target a 3% yield, the number jumps to $400,000. Suddenly, that $5,000 deposit feels very small. The reason this math hurts is psychological. We are wired to look at the stock price, not the yield mechanics. When we see a share price of $100, we think, I can afford that. But we forget that the share price has almost nothing to do with the income it generates. A stock costing $100 might pay $1 a year in dividends. Another stock costing $50 might pay $2. We fixate on the accumulation of shares rather than the accumulation of yield. We tell ourselves that if we just keep buying, the income will magically appear. But the math does not care about your effort. It only cares about the ratio. If you are building a portfolio with a 1% yield, you are unknowingly signing up for a marathon where the finish line is over $1 million away. We ignore the denominator of that equation because confronting the capital requirement is painful. It is easier to dream about the income than to stare at the six-figure price tag required to buy it. So, what is the protocol here? You have to stop looking at the monthly dividend payout in your app and start looking at your total portfolio value relative to that $300,000 target. You need to accept that $300,000 is the baseline for a secure $1,000 monthly income. Does that mean you should give up if you only have $10,000? No, it means you need to adjust your time frame. You are not building an income stream next week. You are building a machine that costs $300,000. Your job right now isn't to live off the dividends. Your job is to build the machine. Once you accept that the target is $250,000 or more, you stop making desperate trades to squeeze pennies out of bad stocks and start focusing on the only thing that matters in the early stages, which is aggressive contribution. Now, right about now, the clever part of your brain is whispering a dangerous idea. You are looking at that $300,000 number and thinking, Tom, why settle for 4%? I see stocks paying 8, 9, maybe 10%. If I buy those, I only need half the money. That is the trap door. If you think saving $300,000 is hard, wait until you see how fast you can lose $50,000 chasing a 10% yield. This is where most dividend investors go broke. Let's talk about yield chasing. It is the financial equivalent of eating gas station sushi. It looks cheap, it looks accessible, but the after effects are rarely pleasant. You pull up a stock screener and sort by highest yield. You see names you might not recognize, or maybe some fading giants offering 9 or 10% dividends. You do the math we just talked about. $12,000 divided by 10% is only $120,000. Suddenly, the goal line moved way closer. You think you have hacked the system. Why would anyone save $300,000 when they could get the same income for $120,000? It feels like finding a shortcut in a video game. But in the market, yield is practically a measure of risk. If a company is paying you 10% to hold its stock, the market is screaming that something is wrong. The business is usually distressed, or they are about to cut that dividend, leaving you holding a bag of worthless shares. Here is the math of a yield trap. A dividend yield is simply the annual payout divided by the stock price. If a stock pays $1 and costs $20, the yield is 5%. But what happens if the company gets into trouble and the stock price crashes to $10? The math says $1 divided by $10 is now a 10% yield. The yield doubled, but only because your principal got cut in half. This is what you see on the screen. You see a juicy 10% number. You do not see the carnage that created it. Often, these companies are paying out more cash than they actually earn. They are borrowing money or selling assets just to keep the dividend alive. Eventually, the math breaks. They cut the dividend to zero. Now you have a stock that pays nothing, and because the dividend is gone, the share price crashes even further. You tried to save capital by chasing yield, and you ended up losing the capital you started with. The psychology here is something I call income blindness. We get so fixated on the cash flow that we ignore the asset value. It is like buying a rental property that is on fire because the tenant is paying double rent. Sure, the check clears this month, but the house is burning down. We rationalize it. We say, I am in it for the long haul. I do not care about the stock price. But you should. If the stock price goes to zero, the dividend goes to zero. High yields trick our brains because we process the immediate reward, the dividend check, much more vividly than the abstract risk of capital loss. We feel smart for getting that high percentage. It flatters our ego. We think we found an opportunity that Wall Street missed. But Wall Street rarely misses anything. If a yield is over 7 or 8%, there are thousands of analysts who have decided the risk is too high. You are not betting against the market, you are usually betting against math.
So what is the safe zone?
Where should you actually be looking? Based on historical data and virtually every serious dividend study, the sweet spot is generally between 3 and 5%. This is the range where you find companies that are mature, profitable, and growing, but not distressed. Companies like this usually have a history of raising their dividends, not just paying them. This is crucial. You want to raise every year to beat inflation. If you stick to this 3 to 5% range, you are back to needing that $250,000 to $400,000 portfolio. I know, it hurts to go back to the big number, but a $300,000 portfolio yielding 4% that grows every year is infinitely better than a $100,000 portfolio yielding 10% that implodes. The protocol is strict. Filter out anything with a yield that looks too good to be true. If it is double the market average, it is double the trouble. Stick to the boring middle.
Now, the index fund purists are screaming at their screens right now. They are saying, Tom, just buy the S&P 500. Just buy the whole market and chill. And usually I agree with them. Index funds are the best way to build wealth for 99% of people. But if your specific goal is $1,000 of cash flow hitting your checking account every month without selling shares, the S&P 500 is actually terrible at that job. The math on this is going to shock you. The S&P 500 is amazing for growth. It includes companies like Nvidia, Amazon, and Google. But here is the catch. Many of those massive companies pay tiny dividends, or none at all. Because they dominate the index, they drag the overall yield down significantly. Right now, the dividend yield of the S&P 500 hovers around 1.3 to 1.5%. Historically, it has been a bit higher, maybe closer to 2%, but in the modern tech-heavy era, it stays low. If you are an income investor, this is a massive hurdle. You are buying a basket of stocks where the primary engine is price appreciation, not cash payout. That is great for your net worth on paper, but it is useless for paying your electric bill unless you are willing to sell shares. And for the dividend snowball purist, selling shares is usually considered a sin. Let's run our formula again with the S&P 500 numbers. Target income, $12,000. Yield, 1.5%. 12,000 divided by 0.015 equals $800,000. You heard that right. If you want a passive $1,000 a month solely from S&P 500 dividends, you need almost $1 million invested. Even if the yield creeps up to 2%, you still need $600,000. That is double the capital required compared to a dedicated dividend growth portfolio. This is why people build specific dividend portfolios. They are trying to optimize for yield density. They want to get that income with $300,000, not $800,000. The efficiency of capital for income generation is just much lower in a broad index fund. You are paying a premium for safety and growth, but you are sacrificing immediate cash flow to get it. However, there is a twist here that I have to mention, or the financial planners will come after me. You can simulate a dividend. It is called selling shares. If the S&P 500 goes up 10% and you sell 4% of your portfolio, you have effectively created a 4% dividend for yourself. In fact, many argue this is mathematically superior because you control when you take the tax hit. But psychologically, it is brutal. It feels unnatural to sell your assets. It feels like you are eating your seed corn. When the market is down 20%, selling shares to pay bills feels like financial suicide. Dividends, on the other hand, just show up. You do not have to make a decision to sell, the money just appears.
That psychological safety valve is why people prefer the dividend strategy, even if it requires picking specific stocks or funds, rather than just buying the broad market.
So what is the solution? Do you abandon the S&P 500? Probably not entirely. The SMART protocol is often a hybrid approach. You keep your core growth engine in the broad market because you need that capital appreciation to keep up with inflation over decades. But then, you build a satellite portfolio specifically for yield. Maybe you allocate part of your portfolio to high-quality dividend ETFs, funds that specifically filter for companies with higher payouts. This blends your yield up. If half your money is in the S&P 500 at 1.5% and half is in a dividend fund at 4%, your blended yield is around 2.75%. That brings your required capital down from 800,000 to around 430,000. It is a compromise. You get some growth, some income, and a capital requirement that is attainable. You do not have to be a purist. You just have to be intentional about what job each dollar is doing. We have talked about the target number, that scary $300,000 figure. But we haven't talked about how you actually get there. This is where the snowball metaphor comes from. You have seen the compound interest charts, but there is a dirty little secret about compounding that nobody tells you. In the first few years, the snowball effect is virtually non-existent. It feels like pushing a boulder uphill in the mud. Let me break down the phases of growth so you do not quit in year 2. The concept of the dividend snowball is that your dividends buy more shares, which pay more dividends, which buy even more shares. It is exponential growth. But exponential curves are flat at the beginning. Really flat. If you have $10,000 invested at 4%, you get $400 a year. That buys you maybe 4 or 5 more shares of a decent stock. It is nice, but it is not changing your life. It is barely covering a streaming subscription. This is what I call the boring phase. During this time, 90% of your portfolio's growth comes from your deposits, not your dividends. You are the engine, not the money. People expect the passive income to do the heavy lifting immediately, but for the first 5 to 7 years, the heavy lifting is all you. You are shoveling coal into the furnace, and the train is barely moving. Let's look at the math of the crossover point. The snowball really starts rolling when your annual dividends exceed your annual contributions. Let's say you can save $5,000 a year. To get $5,000 in dividends at a 4% yield, you need $125,000 invested. Until you hit that $125,000 mark, your own paycheck is more powerful than your portfolio. That is the math nobody likes to hear. It means that for the first decade, your savings rate is infinitely more important than your dividend yield. If you are debating between a stock yielding 3% and 3.5%, but you are only investing $50 a month, you are wasting your energy on the wrong variable. You need to focus on getting more cash into the account. The math says the compound interest magic is backloaded. It shows up at the end of the party, not the beginning. This leads to the valley of despair. This is years 2 through 5. The novelty of opening the brokerage account has worn off. You have been throwing money in every month, sacrificing dinners out and new gadgets, and your dividend income is still only $50 a month. You look at the $300,000 goal, and it feels impossible. This is where most people cash out. They say, "This isn't working," and they buy a car or a renovation they don't need. They fail to realize that this flatness is a feature, not a bug. The psychology of wealth building requires delayed gratification on a scale that feels almost unnatural. You have to be willing to be bored for a decade to be free for the rest of your life. The snowball is happening, it is just microscopic right now. You have to trust the process when the results are invisible.
The protocol for surviving the valley of despair is automation. You cannot rely on your willpower to reinvest those tiny dividends. You need to turn on DRIP, Dividend Reinvestment Plan. Most brokers offer this for free. It automatically takes that 14-cent dividend and buys a fraction of a share. You never see the cash. You never get the chance to spend it. It stays in the ecosystem. Combine that with an automated monthly deposit from your checking account. If you have to manually decide to invest every month, you will eventually find a reason not to. Automate the pain. Then, stop looking at the account. Seriously, checking it every day makes the growth feel slower. It is like watching water boil. Check it once a quarter. Measure your progress by the number of shares you own, not the dollar value. If the share count is going up, you are winning, even if the market is down. There is one final leak in this boat that we have to plug. You might build that $300,000 portfolio. You might get your $12,000 a year. And then the IRS shows up and takes a bite out of it. If you build this machine in the wrong type of account, that $1,000 a month quickly becomes $800. And just like that, you are back to square one. Let's talk about where to put this money so you actually keep it. Dividends are taxable events. Unlike a growth stock that you hold forever and never pay taxes on until you sell, dividends force you to pay taxes every single year, whether you spend the money or reinvest it. This creates a tax drag. It slows down your snowball. If you are in a high tax bracket, you could be losing 20, 30, or even more % of your dividend income to federal and state taxes. That means to get a true $1,000 in your pocket, you might need to generate $1,400 or $1,500 in gross dividends. That pushes your required capital up even higher, maybe towards $500,000. Ignoring taxes is the amateur mistake that ruins the math. The math here depends on the type of dividend. Most US corporations pay qualified dividends, which are taxed at lower capital gains rates, usually 15% for most people, or 0% if your income is lower. That is manageable. But if you chase those high yields we talked about earlier, specifically things like REITs, real estate investment trusts, or BDCs, business development companies, those are often taxed as ordinary income. That means they are taxed at your highest marginal bracket, just like your salary. So if you are in the 24% bracket and you add state tax, you might lose a third of your income. So a 6% yield from a REIT might effectively be a 4% yield after taxes. You have to run the after-tax yield calculation. Income multiplied by 1 minus your tax rate. That is the real number that buys your groceries. The psychology creates a dilemma. We want to avoid taxes, so we are tempted to put everything in a retirement account, like an IRA or 401k. And that is smart for efficiency. But here is the catch. You cannot spend that money until you are 59 and a half, without a penalty. If your dream is to use dividends to pay for a better lifestyle today, or to retire early at 40, the money is locked up. It is a psychological tug of war. Do you want tax efficiency, or do you want liquidity? Many people optimize for taxes so hard that they end up rich on paper, but cash poor in reality until they are old. You have to decide what the money is for. Is it for retirement? Put it in an IRA. Is it for next year's rent? You have to pay the tax toll. The protocol is called asset location. You put the tax inefficient stuff, the REITs, the high-yield bonds, inside your IRA where the tax is sheltered. You put the qualified dividend stocks, the companies like Coke or Johnson & Johnson, in your standard brokerage account because the tax hit is lower. This gives you the best of both worlds. You maximize the compound growth of the high yielders without the tax drag, and you build a stream of accessible cash with the tax-advantaged stocks. It adds a layer of complexity, sure, but when you are dealing with hundreds of thousands of dollars, complexity is worth it. A few percentage points in tax savings over 20 years can equal the price of a small house. Structure your accounts before you buy the assets.
The dividend snowball is real, but it is not a cheat code. It is a slow, heavy grind. If you want $1,000 a month in actual cash hitting your account, run the basic formula: income divided by yield. At a realistic 4% yield, you need about $300,000 invested. At 3%, it is closer to $400,000. Sure, you can push yield up to 6 or 7% to lower that number, but you are walking into a minefield of risk. The conclusion is the same. Meaningful dividend income does not come from a $5,000 trading account. It comes from years of aggressive contributions and reinvestment until you have mid-six figures working for you. That is the snowball. It is slow at first, agonizingly slow. And then suddenly you are collecting $1,000 a month, not because dividends are magic, but because you finally built a capital base big enough to matter.
I want to hear from you in the comments. What is your freedom number? Is it $1,000 a month? $5,000? And more importantly, what yield are you targeting to get there? Are you playing it safe at 3% or living dangerously at 8%? Let's compare notes down below. If this reality check saved you from blowing up your account chasing a yield trap, hit the like button so the algorithm shows this to someone else who needs to hear it. Thanks for watching, and I will see you in the next one.